Let's talk about the impending stock market crash, right? The mother of all crashes, the one the news headline says will wipe out your 401k and your Roth IRA, your brokerage accounts, probably even the value of your home. Just everything is going to be completely destroyed. Now, some people are telling you to buy now. They say buy this dip so that you can make some more money in a few weeks to a few months. And some people are saying, well, sell everything right now because it's going to get worse in just a couple months or weeks. And then you should buy that dip. But I'm here to tell you that none of these people know when the market is going to go back up, if it's going to go back up this year. And they also don't know if this is the dip or if this is going to dip further. And all this talk is just speculation, right? Now, I know you may be saying, well, Eann, I read this news article and this famous guy who is an investor, he said that stocks were going to crash in 2020 and they did crash in 2020. So you believe him. He knows what he's talking about. He always knows when the stocks are going up and when they're going down. And here's the thing, guys. If you check the news archives for every single year, going back every single year, the same people are saying the same things, right? So if you go back to 2021, they were saying there was going to be a crash. If you go back to 2020, they said there was going to be a crash. If you go back to 2019, they said there was going to be a crash. And if you go back to 2018, they also said there was going to be a crash. Now, this goes on and on and on for as long as you can research the stuff, right? So the main point here is that if you keep saying the same thing over and over and over and over again, then eventually one day you're going to be right when it happens. And you're not going to be right because you were good at predicting the future. You were just good at saying the same thing over and over and over again until it actually happened. Now, before I go any further in this video, let me just say that this video is not financial advice. This is never financial advice. These are just my opinions. And also, if you are new to the channel, my name is Eann. And on this channel, I talk about ways to make money, ways to save your money, ways to invest your money, bank accounts, credit cards, and just about everything to do with personal finance. So if you like these videos and you like these types of topics, be sure to give the video a thumbs up. I'll really appreciate it. Guys, giving the video a thumbs up is 100% free. Also, subscribe with the notifications on. That way you never miss the updates of when I post new videos on this channel. Now, let's talk about the impending stock market crash, right? So the past couple of days, or within the past couple of days, the stock market has dipped by around 10%. Now, a lot of people are saying this is the mother of all crashes and everything is going to be wiped away. And even if you check the news reports with headlines like these, catastrophic stock market crash isn't over, here's how much it could get worse. These headlines don't really help, or it doesn't make this any easier to stomach for the average investor. So let's break down a couple of things that are happening right now, which is influencing the markets and why we're seeing that dip in stocks, and also my opinion on what will happen next. So let's go back a bit in time. Let's go back to 2020. 2020 is when the pandemic hit and everything was closed, right? We were on lockdown, no businesses were functioning, and so the Fed was worried that this would cripple the economy and send us into a recession. And so to avoid that, what they did was they allowed some stimulus so that people would still have money because they weren't working, and so they could continue living and pumping into the economy. And they also reduced the interest rates. So they reduced the interest rates to near zero, and what this means is that it became very cheap for people to borrow money. So this is why you had these mortgages, for example, at very low interest rates. I think at one point you could even get a mortgage at an interest rate of less than 2%. And pre-COVID or pre the lockdowns, it was on average about 4.5%. So if you wanted to borrow money for any reason, it was cheap to do so. Now, the downside of lowering interest rates is that it sends the value of stocks up, or in this case, it could be a positive. It sends the value going up, and this is why, for the most part, over the past 2 years, stocks have been going up in what seems to be a straight line. So the main idea here is that you lower the interest rates and you pump stimulus into the economy, and then people have more money and they'll be more open to spending this money because credit and loans are cheaper. So they buy houses, they'll buy cars, they'll go finance jewelry and just about anything because they have the money and credit is also very cheap. Now, the downsides of this is that inflation will occur, and that's what we've seen in 2021. Now, inflation is an average at around 2% per year, and the Fed tries to keep it at around 2% year after year. Now, sometimes it may go up to like 3%, but they always try to keep it at around 2%. Now, last year in 2021, and probably right now, inflation is at 7%. It's almost 4 times more than what it would normally be. And the easiest way to think about this is the housing market, for example, right? So back in 2020 and 2021, mortgage interest rates were really cheap, and they're probably still cheap right now. And what this means is that people can buy homes that they probably couldn't afford before because they pay less interest now. This means that you now have more people coming in and trying to buy homes, which means that the inventory is going to go down really quickly, which is what we have seen. And so the builders are now going to increase the prices of these homes because they don't have enough inventory. And hey, if you have 10 homes for sale and you have 1,000 people trying to buy those 10 homes, you could raise the price because they're still going to fight and try to outbid each other to win that sale. So because of all this, the prices of homes and just about everything have soared. And my personal opinion here is that inflation is a bit out of control, and something needs to be done very soon to curb the rapid rising of this inflation before it gets too far out of control. Now, just to let you understand how bad this is, inflation hasn't risen so much since 1982. We have not had this massive rise in inflation for over 3 decades. Now, this is why the Fed has now stepped in, and they're going to try their best to curb this inflation. But of course, they are going to want to do it in a way where they don't create a recession. So to counter this, the Fed would most likely increase interest rates to counter inflation. And just like I mentioned, when the interest rates go down, stocks tend to go up. When the rates go up, then the stocks go down. And that's normally how the markets react. Now, because this is how the markets react, investors were hesitant and they thought that the Fed was going to raise the rates, and this is why the stock market went down. Now, they have decided that they'll try to keep the rates as low as possible. And if necessary, they'll do a 0.25% increase. So even though this isn't happening right now, they may make this decision, or they may actually make this in effect in just about 2 months from now. So this is why some people are saying, well, stocks have dipped and they're going to dip even more when the rates go up. And some people are saying, well, you should buy right now, buy this dip, and then next month it's going to skyrocket and you're going to make a ton of money. Now, enough about my little history lesson. Let's go back to the main question, or the main point. And the main question is, what should you be doing right now? Should you sell everything, or should you buy the dip, and how should you approach this, right? So again, this is not financial advice, never financial advice, but I would say think about what you can do. Do you have a crystal ball that tells you what is going to happen next week or next month? Most likely you don't. So you don't know if stocks are going to plunge some more. You don't know if they're going to go back up. And if they go either way, you don't know when these things are going to happen, right? So the only thing you're left with is your investment strategy. Your investment strategy, and you should also know what you're investing in and why you're investing in it. And this is why it's very important that you only invest in things that you understand. And secondly, you completely believe in your investments. It's like friends that I have that will never touch Bitcoin or Ethereum with a 10-foot pole. They say they don't believe in it, they don't want to have anything to do with it, and they're sticking to stocks, and I respect that. If you go out there and you invest in things that you don't actually believe in, then you're going to act on impulses, and you're going to be easily influenced by everyone that comes along and says, hey, the stock market is going to crash, sell everything now. Or everyone that comes and says, hey, buy the dip right now, take out all your savings, dump it into stocks, they're going to go up tomorrow. So with that said, I'll tell you guys what I'm personally doing right now. And what I'm doing is just tweaking my investment strategy just a bit. So the stock market is down roughly 10%. The S&P 500 is down. And my long-term strategy is to dollar cost average into the market, because based on my own research, that seems to be the best way for me to invest. So I'll be 100% transparent with you guys. The only thing I plan to change is the amount I dollar cost average in every single week. So for example, let's say you were dollar cost averaging $1,000 in your index funds or whatever you were investing in every single week. Now I'm simply going to cut that in half. So I'm going to invest $500 of that amount every single week. and the other $500, instead of investing it or dollar cost averaging into the market, I'm going to put it in my savings account and I'm going to just stack cash. And that way, because I don't have a crystal ball, if there is indeed a market crash, then I'll do like a lump sum deposit in my investments. And this is based on the data that we have, where I know that it is possible that things could get worse. Now, by the way, guys, when I say a stock market crash, I'm not talking about a 5 to 10% dip as a crash. A stock market crash, personally, for me, is 30% or more. So if 30% or more of my investments disappear overnight, then I will consider that a stock market crash. So I'll continue to dollar cost average while the market is down right now by 10%. And if it continues to go down, I'll still dollar cost average in, but I'm going to do that at a slower pace until the Fed actually raises the rates. And then if it dips even further, then I will do some small lump sum type investments. And actually, this is nothing new. This is actually how I've been investing and my strategy for a long time. I dollar cost average, but I save money on the side. And then whenever there's a dip, I will do like a large lump sum deposit. So I'm not worried about the crash. In fact, when I got into investing, I read books, I understood the risk. I believe in what I'm investing in, and so I factored that into my mind. And I know that during my lifetime and my years of investing, more than likely, I'm going to go through a stock market crash. So in fact, I factored in 3 major stock market crashes in my mind. 3 major crashes over my lifetime of investing that I expect to see. And so if the stock market goes down 30% tomorrow morning, it's not going to be all that shocking to me because I was prepared, and the money that I invested, I'm not going to be needing it, and I don't plan to pull this money out for many years to come. So even if I have to wait 10 years for a recovery, I'll be fine. So all in all, my investment strategy is pretty much staying just the same. And guys, this is why I don't do day trading. I see a lot of YouTubers, they're doing day trading. They're making a lot of money, and although they're making a lot of money, it doesn't tempt me to start doing that because I know why I'm investing in index funds, and I believe in my index funds, and I'm sticking to my strategy, not trying to be influenced by, let's say, Jim Cramer, just to give an example, because he says there's a crash every single year, and I'm sure one day he'll be right. One day he'll finally be right. But for now, I'm sticking to my strategy. Now, I'll leave you guys with this, right? Peter Lynch said something that really stuck with me. And by the way, if you don't know who Peter Lynch is, he's a very successful investor. He ran the Fidelity Magellan Fund for 13 years with an average gain of 29.2%, almost 30% per year, which means he beat the market over and over and over again. And he said, and I quote, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in actual corrections themselves." So with that said, I want you guys to comment below and let me know what your strategy is. Are you selling right now? Are you holding, or are you buying? Or are you planning to sell soon, or do you plan on buying more soon? What's your investment strategy right now? And if you guys found some value in this video, as always, give the video a thumbs up. I'll really appreciate it. Also, be sure to subscribe with the notifications on. If you want to talk to me one-on-one, you can also reach me on Instagram. Link is down below in the description. And with all that said, all the best with your investments, and I'll see you guys very soon in the next one.